Source code speaking. Markets open in 8 hours. Weekends are not a break. We track every item class, every step. So Monday has no surprises. Today we go through silver, gold, oil, and a war that is rewriting energy markets in real time. We have been watching the tokens that trade while CME sleeps, and I will tell you exactly what they're saying. And to the so-called teachers and copycats watching this, yes, you. Have you noticed how you are suddenly tracking PAX G on weekends, watching inventory drains, quoting premiums, tape reading, throwing around EMAs and patterns, and using the exact language I share here? Funny how that works. Glad you are learning. You do not accept you are here, but that is a fact. Period. That is not arrogance. That is skin in the game. 2026 is going to get very interesting. Just wait. Drop a comment. Also, one word. That is all. So I know you are here and paying attention. Now let us get into it, and the numbers do not lie. Starting with silver. Silver Western spot is at $84. Shanghai is pricing physics at $96. A $12 gap between what the paper futures market says silver is worth and what buyers in the East are actually paying for real metal. COMEX's total inventory hit 349 million ounces. As of Thursday, down 2.22 million ounces in a single session, 9 consecutive weeks of net drops. The weekly drain came in at 8.4 million ounces, nearly 262 metric tons in 1 week. Simultaneously, LBMA London silver inventory dropped 2.4% in February, now sitting at 870 million ounces. Both major Western vaults are losing metal at the same time. The paper market says 84, Shanghai says 96. The vaults say draining, 3 signals one way, that $12 extra is not noise. And if you watched yesterday's film, you already know the sequence that led here. 13.15, 13.8, 13.7, 14.6. One direction. Every practice, the paper veil does not hold when the warehouse records are emptying. You can fake the price. You cannot fake the physical drain. That is mechanics, not emotion. Gold Western spot is at $5,171. PXG on weekend markets is at $5,177, essentially flat from Friday's close. Kinesis silver at 85.4, almost exactly where Western paper closed. So heading into tonight's open, weekend pricing signals are not indicating a major move in either way for metals. Do not read that as all clear. Read it as the market has not yet fully processed what happened this weekend, because what happened is not small. U.S. and Israeli forces struck important oil infrastructure in Iran. Oil spilled from warehouses into streets, entered drainage systems, and caught fire, creating walls of flame on Thrawn's highways. Residents woke Sunday to a skyline covered in black smoke and acid rain clouds. Iraq's oil production has collapsed by roughly 60% as the conflict blocks ship movement. And on Hyperlid, the decentralized futures platform that doesn't stop when CME does, used oil is currently selling at $115 after reaching a high of $126. Brent at 97 on the same platform. The oil infrastructure is not the only goal. Reports suggest the U.S. and Israel are planning to send special forces into Iran to seize its nuclear stockpile, roughly 450 kilodolars of highly enriched uranium, enough material for approximately 10 nuclear weapons. If that operation goes forward, a ground incursion into Iranian territory is no longer a contingency. It is a stated objective that changes the duration calculus entirely. Now, let me be precise about what the hyperliquid prices mean. Directional signs, not guarantees. The supply disturbance is real. The war is real. None of that means you press buttons the second the CME starts tonight. Markets have a way of punishing the obvious move, and right now, nothing is more obvious than oil going up. If you do act at the open, that is entirely on you. This is financial warfare teaching, not a signal service. Weekend crude tells the real story. Use dirt on hyperliquid, which is up 5 to 6% as of now after hitting a high of 10% earlier. Brent up 6%. Mainstream headlines are pushing a de-escalation narrative. Energy markets are not buying it. They are pricing supply danger, not peace. The Strait of Hormuz remains the major pressure point. Roughly 20% of world oil flows through that single passage. Then Iran struck a desalination plant in Bahrain. That information matters beyond the headline. Kuwait draws 90% of its water from desalination. Qatar is near 100%. The UAE and Saudi Arabia are both above 70%. When that infrastructure becomes a battlefield target, the escalation calculus changes totally. Iran's foreign minister warned that attacking infrastructure carries grave consequences, then showed it by hitting Bahrain's water supply. The conflict has moved past missiles and military sites. It is now infrastructure warfare across the same Gulf shoreline, directly facing Iran across the Persian Gulf. Once energy systems, water systems, and shipping lanes all become simultaneous targets, the area becomes a systemic risk zone. and oil markets stop pricing supply and demand and start pricing geopolitical survival. Saudi Aramco surged the most since April 2023 on Sunday, and the story underneath that move is bigger than a stock price. Aramco fields came under drone attack this weekend with minor damage at the Berry site and the Ras Tanura refinery, Saudi Arabia's biggest, forced to halt operations after last week's strike. The company is now rerouting shipments through Red Sea facilities on Saudi Arabia's west coast to avoid the strait entirely, with 8 supertankers already loaded this month on pace for a record. Aramco also raised its April oil price for Asian buyers by the most since August 2022, and earnings dropped on March 10th. South Korea is weighing an oil price cap for the first time since 1997. The last time oil markets looked like this, people called it the 1970s. Supply shock. The inflation rate strategy could not touch. Dollar confidence under pressure. If you know what gold and silver did in that decade, you already know what this example means. There's a strategic factor worth sitting with. Higher oil prices hit manufacturing countries, particularly China, harder than energy producers. Higher import bills, a smaller trade surplus, fewer exports, and oil priced in dollars mean every purchasing nation must first acquire dollars. That is not a mistake. It is design. Gold becomes important in this framework. A structurally higher gold price strengthens national balance sheets in an over-leveraged world. Energy, gold, and geopolitics are not different stories right now. They are the same story. Trump stated openly, the war will continue for a little while. Declined to project a schedule, and when pressed, said whatever it takes. 3 words that are not a de-escalation message. That is a war economy message. The U.S. has spent approximately $6 billion in the first week alone, $4 billion on munitions, mostly missile interceptors. That spending rate is a data point about duration, not just volume. Iran has selected a new supreme leader and will announce the name soon. Israel immediately stated it will target every new leader Iran installs. Iran declared it is prepared for full-scale war. These are not comments that de-escalate. These are words of entrenchment. China moved into the frame with formal language. Foreign Minister Wang Yi, speaking at the National People's Congress session, said, China stands ready to return order, tranquility, and peace to the Middle East. This is Beijing signaling strategic interest in the region's future architecture at the exact moment the current architecture is under maximum stress. Iran is a key node in China's Belt and Road infrastructure. Middle Eastern oil flows primarily east. China's stance here is calculated positioning. Now the risk asset picture, because it connects directly to where capital is going. Over 190 billion wiped from the crypto market in 3 days alone. Bitcoin is down over 8%, Ethereum nearly 10%, and that is on top of Friday. The S&P, Nasdaq, Dow, and DAX all closed lower. 900 billion wiped from U.S. stocks in a single session. Risk assets are pricing a prolonged war across the board. Now, private cash. BlackRock just limited withdrawals from its $26 billion HPS business lending fund after receiving $1.2 billion in withdrawal requests in a single quarter. I'm looking at that really closely. They capped redemptions at 5% and stopped the rest. Blackstone's $82 billion fund hit record withdrawal requests the same week and had to add $400 million of its own capital to cover exits. At Blue Owl, investors pulled 15.4% out of one fund in January, causing the firm to sell $1.4 billion in loans just to fund the payouts and permanently halt traditional redemptions at that fund. 3 of the largest alternative asset managers in the same window are all hitting the wall. Howard Marks wrote in Mastering the Market Cycle that cycles turn at the point of maximum ease when the risks feel most remote. Nobody was pricing ILI liquidity as a problem 18 months ago. Now 3 funds are blocking exits in the same week. The cycle does not announce itself. It just starts closing doors. Now gold, because the mainstream is not framing this properly. GLD just recorded one of the biggest weekly outflows in recent years. $4.2 billion was left in 1 week at near all-time high prices. Someone is selling the paper. The actual price is not following. Gold is still above $5,170 with that amount of selling hitting the tape. When paper buyers cannot move the price down despite record selling pressure, the structure underneath is anchored, not fragile. That divergence is the signal. Now, the resistance case always has both sides. Paper markets still dominate short-term price finding. A ceasefire report, a DXY spike, or coordinated algorithmic selling can flush silver fast. Physical tightness means nothing to an ALGO running a stop hunt. 115 on Hyperlid is a weekend signal, not a Monday certainty. And the data calendar this week is loaded. CPI on Wednesday, GDP, PCE, and JOLTS all hitting on Friday. Any one of those prints landing in the wrong hands, paper sellers, is exactly the window they need. Respect that short-term volatility is real, and it does not care about your theory. This is financial battle education, not investment advice. But here is what the complete picture shows going into tonight's opening. 9 straight weeks of COMEX vault drain, LBMA silver down 2.4% in February. Silver finished Friday at 84.6, rejecting 85 three times despite the dollar being down. That rejection is worth watching. Gold closed at 5,170, moving toward the tape reading objectives we mentioned. Friday, 5,181, then 5,200. Gold was the stronger of the two on Friday, and that relative strength counts. Friday 8 a.m., lows remain the invalidation for both. Watch the CME open tonight at 6 p.m. Eastern. Watch COMEX silver inventory through the week. Watch CPI Wednesday. Inflation data dropping into an ongoing oil supply shock is a particularly interesting read. Verify everything. COMEX reports are updated daily and freely available. LBMA statistics provided monthly. The BlackRock file is on Reuters, March 6th. The ones who check original sources don't need to take my word for any of it. One question to sit with before tonight's opening. PaxG and Kinesis silver are flat from Friday's close, while oil is at 115 and tan is covered in black smoke. What does the metals market know that we don't yet? Or what is it about to learn? Invest with reasoning, not hype.